Welcome, everybody, to the Albi Afterhours podcast. Super excited to kick off today's episode with Jeff Moore. He's a very loved industry leader within our tiny little restoration industry here. He's been in the restoration industry pretty much his whole life. Currently sits as the president and chief acquisition officer over at ATI Restoration. And today we're going to dive into some of his life story as well as the type of business that you guys as restorers should be building. Welcome to the podcast, Jeff. It's a pleasure to have you on.
Thank you so much for having me, Alex. Excited to be here.
So, Jeff, for those, a lot of people obviously know you and they know a lot about you, but maybe for those that don't know you, haven't really heard about the ATI story and stuff like that, I'd like to kind of start out by just, you telling your story, kind of telling our audience a little bit about you, where you started, and then obviously the fun question of what got you into restoration.
Sounds great. So I'll start with the company. So, who is ATI? We are, like most restoration companies, we are a full-service restoration company. I think something that's different. We started off as an abatement company back in 1989. So Dad founded the business. We did 100% abatement work our first couple years. And, our first $1 million account was actually a restoration company. And then eventually Dad broadened his horizon, started offering services. We still offer asbestos work today, but who is ATI today? We're across the country. We've got 60 plus locations, 2,500 plus employees, doing work for every type of customer, small jobs, big jobs. Average job size is $14,000. So it's a family business. It's grown exponentially pretty much since inception. I've got two younger brothers in the business. Dad founded it. Dad grew up in the restoration business. Dad's only had 3 jobs. My brothers and I have only had 1.
Wow.
My story, similar to my dad. My dad was a carpet cleaner when he was in high school, working for a really large restoration company today that we compete against. And so his theory for me and both of my brothers was working our way up within the organization. So went to college all throughout high school and college, worked in the business, everything from accounts receivable, payables, construction project manager, estimator. I think I opened up 6 to 8 of our locations, greenfield, in markets that I didn't live in and travel to. And today I'm the head of acquisitions. And so I spent a lot of time in the industry doing the work, getting the training, both from our RIA and IICRC. So certainly educated collegiately, but also certainly School of Hard Knocks in the industry and through most of the reputable training certifications that were around back when I was doing that, probably 10 to 15 years ago.
Got it. Awesome. And why did your dad decide to get into abatement and carpet cleaning out of all the potential things? You said he had 3 other jobs. How did he settle on that?
So all of the jobs were in this industry. So
Okay.
I don't know that Dad grew up. I mean, I think his dad was a salesperson. His mom was a teacher. I don't know that he grew up as a kid wanting to own a restoration company. I think one of his best friends in high school, their dad owned a restoration company. So that's, that's why he was cleaning carpets at 16. And, he basically worked for them most of his career through high school and college. And so I think just like most of us, I don't know that anyone, unless your dad's got a business, you don't necessarily have a desire to jump into the restoration business. I think we all just kind of land on it accidentally, coincidentally, opportunistically, however it happens. And I think that's how it happened. And I think, Dad had expanded into California. He started in '89, so asbestos just got banned. And that's where I think they were already doing environmental work. And that's when the pre-crux of why we got into the environmental business. But honestly, restoration just kind of naturally happened to Dad, our family. And if it wasn't for those accidents, we wouldn't be around.
Oh, wow. And at the time of, your involvement, was ATI a thing, or was it a different company that was doing the abatement?
So it was still ATI. Yeah, so it's been ATI. We've had, I don't even know how many name changes. We've been ATI, American Technologies. We had an American Restoration DBA. We're all over the place, and now we're a combination of both of the names we once had. So yeah, we went from being 100% abatement to, we might be doing 10% of our revenue as an asbestos, where at one point it was 100%. So again, the business has evolved, and I think as any successful entrepreneur. What you do yesterday, certainly what you did 3 or 5 years ago, can't be what you're doing today, not if you're in a growing organization.
I see. And you mentioned now you had, I think, 2,500 employees, 60 some locations across the U.S., obviously market leader within the restoration market. What did it look like back in, the early 90s when, you and Dad joined forces?
So I was working for him in high school in '94. We were a tiny mom and pop doing a couple $1 million a year. When I worked for him full time in 2001, joined him out of college, we were probably doing maybe $20 million in revenue, maybe 3 or 4 locations. So $4 or $5 million each. Very successful restoration company. Still, it would be very successful today, but certainly not the company that I work for today. And that's where we've had, I think our compounded annual growth from '89 to now is still in the high 20s, almost 30%. So just been incredible growth ever since. So no, the company that we had 5 years ago, I think we ran the math every 4 to 5 years since 1989. The company has doubled in size. So
Wow.
each one of those marks it's not the same company it once was.
Got it. And how were you able, it's typically, I find it unusual for a person to be able to grow as fast as a company growing of that speed. And you've mentioned that you started in the company down in the trenches, and now obviously you're the chief acquisition officer, meaning you're doing a lot of M&A deals, a lot of things that you probably didn't do when you were a $20 million a year company. What was your key to growing and developing yourself personally so that way you can handle the responsibilities that you handle right now?
So I think it's twofold. I think from the business perspective, it's hiring smart and hiring people that are smarter than you. I think that's part of it, and I think it's the other parts. It goes both for employees and yourself. You've got to invest in yourself. Honestly, I mean, I look at companies all day long, Alex. I know financials better than I did when I was in the business, running the business. I look at EBITDA, which is earnings before interest and depreciation. I didn't even know what that was, Alex, 4 years ago. And it's something I talk about every day. So you have to be willing to adapt. And if you don't adapt, you die. And you have to be willing to be humble, have humility. I don't know it all. I'm learning every day. I didn't know anything about M&A. I never in my farthest dreams would have imagined I'd be running an M&A group within ATI. Just 5 years ago, that wouldn't have even been comprehensible. But it just naturally happened, and you have to be willing to learn. Go out there and read. I mean, School of Hard Knocks is the best way, but you've got to read books. You've got to listen to podcasts. There's lots of ways to learn something you don't know, but you have to put in the time, the investment, the capital, and that applies to both you and your employees.
So you mentioned investing in yourself, which I believe in dearly. I'm in a lot of mastermind groups. I read a lot, just like you kind of mentioned, and things like those. Can you give some more concrete restoration-specific investing in yourself tools that maybe restorers have, but maybe they don't know about that exist out there?
Yeah, so I think whether it applies to you, whether it applies to your employees, I think if this is a career that you want to be in, I think from a technical perspective. Obviously, IICRC is at the forefront of everything, but if you truly plan on running a business, you ought to be carrying some sort of master designation. It's basically accumulation of a bunch of IICRC designations. I happen to have 3 of them, spent a lot of time doing that, something you ought to be putting your employees through. RIA, I would say an advanced master designation in IICRC would be like I don't know, maybe it's an associate degree in college. If you want to get your bachelor's or your master's degree, you go into the RIA track. It's a multi-year commitment. It's a financial time investment of capital, but they have water loss specialists, there's environmental, there's your certified restorer. That's the cream of the crop. There's only the CR, which is probably their most pinnacle restoration certificate. I was number 600. I don't think there's 800 of those in the country, Alex. When you look at the WLS within the RIA, I don't even think there's 200 of those in the country. So, and then I think there's other things like Actionable Insights does some great things. I think Great Drawing Academy, Large Loss Mastery with Tom McGuire. Actually, I'll tell you, we sent all of our top estimators in the entire country to the Large Loss Mastery course. And a lot of times when you send employees, you get mixed bags. Some people really love it. Some people say it was a waste of time. I had some of my most tenured, seasoned people that know the industry inside and out. They went to Tom's class and they came back and thanked me 10 times over and said, Jeff, you sent us to a bunch of courses, some of which were not worth our time, but this one was incredible. Even as someone who's handling $5 and $10 million jobs, I learned a ton going into this class. So I think there's a lot within industry, but I also think there's just as much outside. The industry is going to give you a technical base, but if you want to be a good leader, you want to grow, you've got to go outside the industry. There's groups like Vistage. If you're a CEO, there's groups like YPO. There's you can have coaches. I mean, it's literally endless on what you can do, but the technical stuff is only going to get you so far. If you're looking to grow the business and run an organization, the technical skills are great, but as you grow, those become less valuable to you personally, and those general broad leadership courses and opportunity are, quite honestly, they're more valuable.
Yeah, that's exactly what I was trying to get to. I feel like the restoration industry as a whole does a phenomenal job on the technical training, but oftentimes if you're looking to build those valuable businesses, you also need the leadership skills and how do you build the people that build the business versus at the beginning you're building the business. So,
yeah.
So kind of moving on, you talk to, I assume, hundreds of restoration companies a year. You've obviously done many acquisitions. If we're talking about the dream restoration company or the restoration company that, most other companies want to acquire, can you describe a little bit what that looks like?
Yeah, I think the ideal company has a set of services that are full service. Most people want to buy someone that can handle jobs of all sizes and scales. They don't want someone who only does construction or mitigation. I think at the end of the day, no different than whether you're buying a piece of real estate or a stock or anything else you're investing in, you want to see an asset that's continuing to grow. No one, if I had a piece of real estate here in Phoenix where, just like the rest of the country, the market's been stagnant, it's going up or down, it's a little bit more concerning to invest in. So if I'm looking at a restorer who's hasn't grown in 5 or 6 years, I may want to buy that. That may not be the ideal investment. Maybe there's a reason they haven't grown, but ideally I'm looking for a staircase. I'm looking for a staircase of growth. I'm looking for a staircase of talent. I'm looking for someone that, even if I do nothing that brings value to the business, which shouldn't happen, but in theory, the business will continue to grow because they've got great leadership, they've got great people, they've got loyal customers, and it's growing on a year-over-year basis. I think you're looking for stable, repeatable. There's a lot of companies that do big revenue, but they're doing it in an unstable way. And when I talk about that, Alex, I'm talking about where are you getting your work? Because if your business is an up and down like the stock market has been the last 3 years, you're probably doing more hurricane work, you're doing more large loss, you're doing cat work, you're not doing work in your day-to-day business. I'm looking for that operator that is stable, is working in their confines of what's close to them. The guy or gal that's jumping down to Florida, to Fort Myers, who's operating in the middle of Ohio, that's not attractive. That's great from a revenue perspective. That's great from a cash, but that's not repeatable. It's not scalable. I'm really looking for someone that owns a market and dominates a market and has a potential. And ideally, I'm looking for an owner or a management team that's solid, that's not going anywhere. But there are cases where owner's 65 and needs to retire. If that's the case, if you want top dollar, or if you want to have as many options as possible, you've got to have a great number two. We talked about investing in people and capital. The more it's you and it's only you, that business is no longer valuable, because if you're gone, or even if you say you're going to be around, there's always doubt in a buyer's head. If you leave, what does that do to me? And if that tanks my investment, I don't want to do it. But if you've got someone who's capable of running it behind you, I meet them, then that business is exponentially valuable. And the less it's dependent on you and it's more dependent on a team, the more value you've created.
Awesome. So if we're going to go and say good, better, best, right? So best being you knocked your socks off, you're super excited, good is all right, it's acceptable, better is right there in the middle. What would you say year over year growth rates would be, kind of if we're at a benchmark? Here's what I'm looking at. Over this much, knock my socks off, between this much and this much percentage-wise year over year, that's good, and then better, and then best.
I'd say best in class, top 5% are growing by upwards of 15, 20% a year. I would say a good business is growing by, call it 5 to 10%, so then maybe 10% and greater is best in class, and then anything sub 5% is what I would consider normal growth. And then you've got others that quite honestly aren't growing at all or have been fairly stagnant over a 3 to 5 year period.
Got it. Makes sense. And then you mentioned that that is consistent revenue, so they're typically more than likely going to be local within an area. I do want to touch on like TPA versus independent a little bit later. We'll touch on that, but they're nurturing their own leads, right? And then the business is running probably with minimal owner involvement, and there's a number two in charge, kind of adding to the equation. Cool. Awesome. Is there now obviously 15% year over year might sound, there might be a listener here that's like, oh, well, I grew from $1 million to 3 years last year. That's 300x year over year. Obviously, we're talking about a minimum threshold too that is typically attractive. And what would you say that if we're going to add to the benchmark, another minimum threshold would be like, what's a revenue run rate or an EBITDA number that you would say is that's where the game starts?
I would say you talking about raw EBITDA or EBITDA growth?
Well, so I'm talking about raw EBITDA, or if we want to make it simple for listeners, let's just talk about revenue, assuming whatever, like last time we talked, we assumed a 10% EBITDA. Yeah. So let's just say revenue, like what's the revenue scale of a full service company at which it's like the minimum for an acquisition like this?
So I would say if you want to be best in class, if you want to have ATIs of the world and my competitors that are out there where you see press releases, best in class, you probably want to be 10 million in revenue minimum and probably pushing 2 million in EBITDA. If you want to have the best strategics bidding or fighting for your business, I would say like a tier 2. There's quite a few strategics that are out there buying companies and call it the $1 million EBITDA plus, call it $5 to $10 million in revenue. So that would put you in your tier 2. And then I think you get into your tier 3s where I think you could be $3 to $5 million in revenue. EBITDA varies in businesses like that. You do tend to see higher EBITDAs as a percentage of revenue in smaller businesses. So you could be probably need to be 500,000 on the minimum to really have anyone take interest and want to acquire you. And I think someone doing $5 million, I've seen people do $2 million in EBITDA, but it's because they have low overhead depending on where they're getting their business from. But that buyer pool, you've got less strategics. You're looking at more single owner investors, family offices, on employees within your own business or someone coming from industry. But you may not get, obviously your different multiples on each one of those scales and what the business is worth.
Got it. Awesome. So for those of you listening that don't know what EBITDA is, in the description below, we'll put in a link to a calculation of EBITDA. Your accountant should be able to help you figure that out also. Now, Jeff, back to you. From the sense, we've talked about top line revenue, we've talked about EBITDA. Are there any other unit economics that matter? Like, do you look at the cost of goods sold of a company, or if cost of goods sold's higher, but it's compensated by a lower overhead, you're happy? Or if cost of goods sold is lower, but there's a higher overhead, you're still happy as long as the EBITDA numbers shake out? Or is that important to you?
So, normally when you look at an evaluated business, and when we first started this, all of those mattered. As we've done it more, it means less because there are so many companies putting different things in the top of the line into GP and others putting it into overhead. It's so different. I mean, I look at 100 companies, no one's doing it the same way. So that's where we focus more on the bottom line. Are you growing on the bottom? Whether that's if you're running net income, you're looking at EBITDA, but ultimately I'm looking for that to grow. Again, just like the top line, I'm not looking for someone who scaled the business and grew from 10 to 15 million, but is making the same on the bottom. That's not attractive at all. Honestly, I'd rather see someone stay at 10 million flat for 3 years and grow the bottom line, whether that's through margin expansion, how they're getting their business, holding people accountable. That's actually more attractive than actual raw growth. And I can tell you as a family, at one point for probably 15 or 20 years, all we cared about was top line growth. And what I know now, that was absolutely the wrong mistake. There was years we would grow. I remember a year, I think we grew from 100 to 120 million in revenue, and we actually made less money on the bottom. And so that's not true growth. Again, if it's just you and you're only feeding you and your family, it may not be as important, but ultimately you want to grow your business to where it's attractive to anyone, because anything can happen at any given point. And I think ultimately you want to run your business. Like I said earlier, no one no one has. I don't know that I've met anyone that decided like this is the business. I went to college. I've decided I want to be in disaster recovery. People did this either one because they thought it was a great opportunity. It was recession proof. They knew someone that was in the business. They wanted to help people. I think there's a multitude of reasons why you do it, but ultimately we do things and we work our asses off because we want to provide for our families. At the end of the day, that's all that's important. And we want to make sure our families are taken care of, but you want to build a viable business and you want to be able to exit it, whether it's because it's top dollar, you've done everything you can. I've talked to too many people where they are now forced to do it because of an accident or someone got hurt, or I've got another one where someone's getting divorced and they're forced to sell the business. If you weren't always managing the business as if you were going to have to sell it, you're going to screw yourself. And that's not why you started the business to begin with. So go out on top, run it as if you're going to sell it to someone today, tomorrow, next year. You never have to sell it. But if you always have that in mind, because ultimately one day you will have to sell your business. You're not going to work till you're 100 years old. Whether you sell it, you gift it, you still want it to be as profitable as possible.
Makes sense. Awesome. So build the valuable business as if it's going to be sold and as if it's going to have all these bids from private equity and from M&A advisors today, and then worry about being put in the position on whether or not you're going to sell it or it's the right time for you to sell later. But don't put yourself into the position where you have to sell out of disparity or you have to sell there, because then you really don't have leverage. You don't have the power to say, you know what, Jeff, you gave me a bad multiple. I'm not going to sell to you right now, right? You don't have that power when you're selling out of disparity. Whereas, when you're selling out of strength, the market could dip, it can come back up. You have a very valuable business, you know what you have. So,
yeah, and it may not even be out of disparity. If some of the key metrics that we talked about aren't there, you may not get an offer. I can't tell you how many companies that we're still talking to that went to market, they received some initial interest, and ultimately no one was attractive to them. And a couple of them I reached out to. We were not the high bidder, we were the mid bidder, and we thought they were going to sell. And some of those were 3 years ago. And I asked what happened, and for whatever reason, the buyer wasn't interested. They pulled out, and they went from 8 offers to 0 offers, and they still haven't sold their business. And they needed to 3 years ago, but it just wasn't an attractive business. Just because you want to sell doesn't mean someone's actually willing to pay you money for it. Even at a low offer, sometimes you don't get low offers. I mean, how many times do you put a house on the market and I got to sell my house because I'm getting transferred for work, and even if I'm willing to take a lowball offer, doesn't mean I'm going to get an offer at all, and then that's just bad for you.
Mm-hmm. Makes sense. The other thing I wanted to touch on is we talked about TPA versus independent. We talked about how you get your work. Is there any difference in how you look at a company? Let's say, Contender A is a $10 million a year company doing all relationship marketing, has insurance agents, plumbers, property managers within a market referring them. And then Contender B is 100% vendor work. So they're, on contractor connection, alacrity, things like those. Is there any difference in those two companies? And are there certain strengths and weaknesses you find in those two examples?
100%. So I would say the least valuable is anyone doing 100% TPA work. It's, as we all know, you do have to perform. It's hard. It's hard as to be really good at it. So I don't want to discredit how difficult it is, but the reality is you are not generating revenue. I could technically put an ATI office in that same market as long as I operate it correctly, and I could, in theory, take market work from you, which makes your business less valuable. I'll also tell you, as someone who does a lot of program work, you're one job away from getting kicked off of a customer that may be throwing you 30% of your revenue. So that's more at risk from one customer complaint. You just don't know where that's going to happen. We've been kicked off entire programs from certain carriers in a local office, regionally and nationally, over something that quite honestly was BS. And so that's why it's not as valuable. Now, someone doing 100% non-TPA work is definitely more valuable, but I don't know that they're any more valuable than someone who's doing 50-50 or even 60-40, regardless of which direction they're getting TPA or non-TPA work. But the fact that they've got accounts, as long as you don't have what I'd consider customer concentration, and when I say concentration, you're not doing north of 30% of your revenue with any individual adjuster, property manager. I don't care if it's contractor connection, because I know there are so many people within that bucket of carriers that you're doing. But if you're doing more than 30% of your work with anyone, a plumber, anyone else, your business will be devalued. So that's actually probably worse than doing 100% TPA work. I did look at one business. We never put an offer in on it. They were doing 100% commercial work, but they were getting like 85% of their revenue from one customer. High margin. It's a customer I wanted to buy into, but they are one job away from that business being defunct and bankrupt if they lose that customer. So just make sure you don't put all your eggs in one basket.
I see. Awesome. Super cool. So diversifying is very important. Now, moving on to another question, and my next question for you would be, you're clearly seasoned, you're a CR, you've got this entire team behind you that knows how to build restoration companies, you're an expert within restoration. So when you mentioned plopping an ATI office somewhere, why are you going on this M&A spree versus going into Chicagoland and plopping in your own ATI office and growing it from 0 to the 10 million or whatever versus buying? Like, what's the point of M&A? And I know a lot of listeners probably have that question, like, why not just build it yourself? Why are you looking to buy?
So valid point. So I would say our first 25 years, that's what ATI did. Maybe our first 30 years. It's hard as you know what. I mean, it's one of the hardest things we've ever done. So, going, again, the closer you are to your office or where you're domiciled, if I'm in, say, Oak Brook, where you're at right now, Alex, in the suburbs of Chicago, and you're running a restoration business, it's a lot different if I want to go open up an office in downtown Chicago, where maybe some of the adjusters, my property managers are the same. But if you want to go out up to Michigan, that's a whole different world. There's not going to be as many synergies, and you're only going to be as good as the person you put in there. So if I'm in Oak Brook, and if Alex has someone really talented, you could probably be successful in Detroit, because I think you're still close enough. But you also risk the chance of continuing to lose margin, EBITDA, revenue in Oak Brook if you're now spending a third of your time in Detroit. And so you're only as successful as a person you put out there. So yes, ATI could go do that, but I'll tell you, there's an office in particular. It took us 10 years to be profitable. To make $1 took me 10 years. By buying someone, I've got customers, I've got subcontractors, I've got loyalty, I've got some sort of brand awareness. I'm not in Detroit today. ATI is not. We are not well known unless someone's on the national scene or a large real estate group or an executive general adjuster who's traveling the country. We're not going to be known by the local Allstate adjuster or agents in Detroit, Michigan. That could take me 10 years to build up. And so buying someone allows me to be able to service national customers day one, gives me some sort of local brand awareness, gives me an operational excellence. I've got subs. I can handle whether it's a $10,000 job or a $500,000 job tomorrow that we generate. I know that local business can handle it. Where if I'm sending a person out there, it's just going to take time and capital. Where if I buy someone, I know I'm making money the first month. Where if I'm doing a greenfield, i.e. from scratch, I'm going to spend, depending on the size of your operation, you're going to spend, even on a small scale, you're potentially going to lose hundreds of thousands of dollars in year one, if not more, depending on how much you're scaling it up, because no one knows who you are. Again, and the farther you go, the harder it is. And we've just learned, I'm happy to do greenfield as long as it's near or around one of our locations, but I don't want to go to Detroit, Michigan, because my closest office is Chicago. It's too far. That would not make any sense.
Got it. Awesome. Thank you so much for clarifying that. I appreciate it. So last two questions, and the first one is, what do you think is the biggest bottleneck for our listeners out there struggling to grow and scale their business? What do you think holds them back? What's that bottleneck, and what do they need to break through to be able to build that business that's super attractive for someone like ATI to come and acquire?
So I think it varies based off the size of your business, but your average restorer in our industry is doing $3 million a year. If I'm your traditional owner, the more you're working in the business instead of working on the business, it's really hard to scale. If you are running jobs, you're estimating the jobs, you're taking adjusters golfing, you're entertaining customers, you're not working on new customers, you're not working on strategic hires and employees, you're just trying to get done what's on your plate. And so the more you are in the business. There's nothing wrong. I've been in the business for a lion's share of my career. All four of the family members have. But you can't grow and scale the business. You can't look at it from a strategic perspective and say, okay, I'm getting my business through TPA. I've got a couple adjusters. I got some property managers. Where else should I be getting business? And these relationships are all me. So maybe I need to go hire someone in business development that can take a day and a half away from me. I am now estimating 50% of it. If I can estimate only the large loss or 10% of the jobs and free up 3 days of my time, I can go generate new work. I can figure out if I want to expand into a new market. I can get TPA work. You can get work in new markets, but you need to have a strategy, and you can't do that when you're just trying to put fires out every day. And the more you're putting out those fires, growing becomes really hard unless you're going to hire someone because you love the day-to-day. That's another option, is you don't have to be strategic. You can be the day-to-day operator, but hire someone that you're going to report to in your own business that's going to be strategic in their thought and their leadership and their skills. Not everyone has those skills, Alex. Not everyone wants to do that. Some people want to be in the day-to-day thick. And if that's the case, figure out what it really is that you want to be and go hire someone to figure out your blind spot.
Awesome. So work on the business versus working inside the business. Yeah. And you also mentioned earlier that if the business is heavily dependent on you to be in the business, that's not as attractive for, any sort of strategic acquisition. Very awesome. So the last thing that I would ask is there something that we didn't cover or something that you wanted to tell people that are listening to this podcast that we might not have dove into yet?
So I think there's maybe two things I'll talk about. One is margins. I think margins are really important. So making sure that you're always, again, that's on the top line, but the more metrics you can show growth in. So making sure you're growing in construction, your margin, mitigation margin, making sure you're focusing in on the bottom line. Again, you want to see that staircase of growth. And then I just say the M&A landscape in general for anyone who's listening that's considering selling, there's no right time or wrong time to sell, but I would say there's a lot of outside dynamics that can hurt or help you. I would say the market in general, the last 2 years has been great. This year, not as great as others. You've got things like interest rate. I mean, I pay a higher APR interest rate on my credit cards, which means if I want to buy a restoration business, I'm borrowing capital. It costs me a lot more money. It's probably costing me twice as much as what it did before. Which is why people aren't buying houses the way they were before, because what I could have bought 2 years ago, I can't buy as much because the interest rate is eating into that. And so that is driving multiples down. It's driving valuation down. We're going into an election year next year. So all of those things make it even more important to make sure you're focusing in on a profitable business. And again, you want to be able to sell when you're ready to sell, but there's always outside metrics and variables that none of us can control. It's the world, it's the economy that will make our industry more and less attractive to outside investors. So, always keeping that at your forefront. A lot of us don't think as, the Fed raises interest rates by a quarter point, what does that really mean? Okay, I'm going to pay a little bit more, but no, that means that, your business may be worth a whole turn or a quarter turn or half a turn less than what it was 2 years ago. So if you talked to me 2 years ago, ATI may not be willing to pay the same multiple that we were 2 years ago. For an attractive business, maybe we are, but those outside metrics do really impact valuation.
Yeah, I could relate to that, having done fundraising myself, and, we've had high valuations in the past, and now we're trying to grow into those valuations. The way I look at it is the tighter the market is, the more attractive I have to be. So if, for example, in a really hot market, I might shoot for being in the top quartile, right? In a really low market, I will try to be in the top 2% or top 5%. So I just try to become way better than I would be in a hot market. And then even if revenue multiples shift or even if appetite shifts, I mean, a really great restoration company that is, best in class will probably always sell, whether it's a bad market or a good market. It's just in a really good market, there might be 15 transactions and you have to be one of 15. And in a really bad market, there might only be 2 transactions and you have to be in the top 2. So I don't know, correct me if I'm wrong, but that's kind of how I look at it.
100%. And then the last thing, I've always got to do a plug for RIA. So for those of you listening that don't even know what RIA is, it stands for the Restoration Industry Association. It is the trade association for restorers. So if you don't know about it, check it out online. It's not a big cost. I don't care if you're doing $300,000 a year in revenue. It's based off your revenue, so it's peanuts. I think new membership, if you're not a member, it's like $250 for the whole year. You get access to amazing tools that can help you drive gross profit margin expansion in your business. We do networking. We've got an event. I think it's in September in St. Louis. We're expecting 100 to 150 restorers. Some of the best learnings I've had have been going to the RIA conferences or regional events where you're like the one in St. Louis, Woodard. I'll brag about them. I think they've got the best looking facility in the entire country. They are, the way it's organized, if you want to look at what you could be like in the future, that is a model you want to see. And then to be able to have a tour by the owner, talk to the employees, meet with other restorers, going to our national conference. You've got to be a member of your trade association. There's so many valuable tools we have. And the fact that it doesn't really cost much money, you just learn from your peers and learn from what we're doing. But you got to be at the table.
100%. This industry needs to unite a lot more than we have up to this point. There's a lot of cool things like the AGA going on and things like those that the RIA is doing. And we need bodies, we need voice, we need the industry to come together. You know, obviously the insurance companies are all together and they all meet up together, even though they compete against each other and they're few and far between. We need the restoration industry to have that voice to be able to move things. So, but thank you for that plug. And then if somebody wanted to reach out to you personally, let's say they want to chat more about M&A, or maybe they're interested in selling their business, or maybe they just want to, tour one of your ATI facilities, how can they reach out to you?
Call me on my cell phone or email me.
Awesome.
You can drop it in the bottom. It's funny, I got someone followed up with me on one of the podcasts I did. He was a small guy in Texas doing, I want to say $2 million a year. He actually followed up with me. He called me. We chatted once or twice, and he wanted to learn how to operate better. And so he actually agreed to fly out to Phoenix, and I hooked him up with my local team, and he spent, I think it was 2 or 3 days. He went through one of our production meetings. He did a ride-along with the manager. One of our estimators and project managers didn't charge him any money. He reached out. I said I'd help him out, and I've got a friend for life in that gentleman that followed up with me. So happy to help in any capacity I can.
That's awesome. Very kind of you. And yeah. Awesome. Well, thanks so much, Jeff, for coming on the podcast. Really appreciate it. And we'll put in the link below. We'll put that EBITDA calculator. We'll also put Jeff's contact information so you guys can reach out directly to him and follow him on social. I know he's got a LinkedIn and a Facebook, and he posts a bunch of things there. And he's also got a couple of groups. There's an Arizona restoration group within the Facebook community and things like those. So, but Jeff, it was a pleasure. Thanks so much again, and we'll keep in touch.
Sounds great. Thanks.